Are we heading toward rate cuts or something worse? Stocks and mortgage bonds are bouncing today, but the bigger picture is getting more complicated. Hey everyone, it's Brian Linchey. Let's break down what's happening in the markets right now, what it means for interest rates, and why global events could play a major role moving forward. Last Thursday into Friday morning, the bond market dropped sharply. Why? Because of growing speculation that the Fed might hike rates again before the end of the year. At one point, Fed futures showed over a 50% chance of a hike, but that quickly dropped to just 7% after a weak consumer sentiment report from the University of Michigan. So what does that tell us? The market is extremely reactive and uncertain. Right now, there's still a strong case for rate cuts by the end of the year. Yes, rising oil prices can push inflation higher in the short term, but over time, higher energy costs tend to slow consumer spending, which can actually be deflationary and even signal recession. And if that happens, historically, the Fed cuts rates. We've seen this before. Back in 2011, the European Central Bank raised rates during what looked like a recession. It turned out to be a major mistake, and they quickly reversed course and cut rates. The bond market may be starting to price in a similar scenario today. Consumers are clearly feeling the pressure. The Michigan Consumer Sentiment Index dropped from 57 to 52. Even more concerning, expectations around unemployment are rising sharply. About 61% of consumers now think unemployment will go up over the next year. Only 13% think it will go down. That gap is something we typically only see during recessions. On top of all this, global tensions are adding uncertainty. There are reports of serious discussions involving Iran and potential control over the Strait of Hormuz, a critical oil shipping route. Any disruption there could impact oil supply, drive prices higher, and add even more volatility to the market. At the same time, the situation remains unclear, and conflicting messaging makes it difficult to know what's actually happening behind the scenes. So where does this leave us? We have volatile markets, weakening consumer confidence, rising recession signals, and growing geopolitical risks. All of this points to one thing: uncertainty. But if the economy continues to slow, the likelihood of rate cuts increases, and that could create opportunities, especially in housing and mortgage rates. If you want help navigating this market or understanding what it means for your mortgage options, let's talk. Call, text, or email me anytime. I'm here to help you make sense of it all.